Very good morning. I am CA Naveen Wadhwa. I am a DGM in Research and Advisory Division of Taxman Group of Companies. So this division looks after the research platform of taxman.com. So I'll be the moderator for today's webinar. So I would like to extend a very warm welcome to all our audience. So we hope everyone is healthy and safe in these testing times. Thank you for taking time to be with us today. So the topic for today's webinar is slum transfers and goodwill amendments. Will it bring much needed clarity or more chaos? So the amendments relating to the slum sale and depreciation of goodwill have been the talk of the town. If I have to summarize the agenda for today's webinar, it would be unlearn and then relearn. So the concept we have to unlearn is slum exchange is not transfer and goodwill is depreciable. So the issue of slump exchange has found favor of many high courts, and the most notable one is the decision of Bombay High Court in the case of CIT versus Bharat Bijli Limited. And the issue of depreciation on goodwill was settled by Supreme Court in the favor of assessee in the case of Smith Securities and Zydus Wellness. So these two concepts now we have to unlearn, and the thing we have to relearn would be the part of today's webinar. So in this webinar, the author will talk about the amendment introduced in the Finance Act 2021, tax position prior to the amendment, rationale of introducing the amendments, impact of amendments on transaction undertaken in the past, impact on goodwill previously acquired, impact on deals structuring going forward, valuation methodologies for slum sale, slum transfer and intangibles. So for today's webinar, we have two prominent speakers. Our first speaker is Mr. Amrish Shah. Amrish is a subject matter expert with over 28 years of tax experience, primarily in merger and acquisition. He has worked with large multinationals, private equity funds, and Indian corporates across sectors. He has deep experience of assisting in tax due diligence, acquisition, divestment, as well as tax restructuring advisory, which includes analyzing tax and regulatory implications, providing assistance in devising a strategy for making future investments in overseas assets, intermediary company jurisdiction analysis, profit repatriation strategies, funding and financing applications. Our second speaker is Mr. Pinkesh Bilumoria. Pinkesh is a partner with Deloitte India. He has been with the firm for over 24 years, out of which he has spent around 22 years in the valuation practice. He has got the specialization in M&A and restructuring related valuations. Over the year, he has gained wide experience over many industries: manufacturing, consumer business, pharma, ITA, C&R, retail, infrastructure, BFSI, healthcare, auto, public sector, and much more. Please join me to welcome both the speakers. Welcome Amrish, welcome Pinkesh.
Thank you, Naveen. Thank you.
So the format for today's webinar will be a formal presentation followed by Q&A session. You can post your queries in the chat box. The speakers will address as many questions as the time permits. At the end of the webinar, they'll read all your chats and will give an instant reply. To the extent possible and to the extent the time permits, they'll address all your questions. So balanced questions can be addressed offline. So without further delay, I'll hand over the presentation to Amrish to start. Amrish, over to you.
Thank you. Thank you, Naveen. As the presentation comes on from Naveen, good morning, ladies and gentlemen. As Naveen mentioned, hope all of you and your families are safe in these times, and also that you got yourselves vaccinated. That's very important for all of us. As with everything around, including the entire World Test Cricket final, which is currently in chaos with the rains that are coming there. I think we are living in a world of surprises. The government also added its bit on the M&A front this time through the last budget, which has a number of enactments, which have now obviously become a law. So, that's, I think, something that we need to learn to live with. Naveen has already spelled out what we are going to cover on this part of the session. So I'll directly deep dive into the session, as we move on. Clearly, I think, there were two big amendments which were very, very important and far-reaching, will have far-reaching impact on how the M&A market in the country is going to be dealt with going forward. And I think the first one was around, the business sale as a concept, including, how it needs to be valued. And the second was around, goodwill, whether that's something that is, depreciable or amortizable, as it is globally called, or that's something which, retains its value throughout its, purpose after being acquired. So what did the Finance Act say? The Finance Act now has expanded the definition of business sale to include, additional types of transfers, including any exchange or through any other mean, which comes within its purview now. So a transfer of a business undertaking will now be taxable, even though there is an exchange and you don't get cash in return, but you may get any other asset, or you are doing it in a manner where you even don't get an asset, except that it is a gift, but you don't get an asset, or you get, less than a fair value. Even then it can be taxed, having regard to the fair market concept. Interestingly, when the budget came, as well as when the Finance Act was passed, this was made applicable from assessment year 21-22. What does this imply? Basically to say that for the financial year ending March 31, 2021, any transaction of slump sale with its extended definition, including exchange, would now be a taxable transaction. And therefore, there is one issue which comes up and which we will debate a little later as to what does one need to do in light of this so-called retrospective amendment. Moving further, the second one, which was more around the block of assets of depreciation, and it says that, going forward, block of assets shall exclude goodwill of a business or a profession. Earlier, as we have looked at it, there was always a debate when intangible assets were included as part of depreciable assets. There were certain assets which were very, very clearly spelled out, and then there was a residual category. And there has been a debate about where does this fall. But, the amendments in the Finance Act says that goodwill is something that will not be subject to any further depreciation. And wherever you have already claimed goodwill, as earlier, because there were certain elements which could be claimed as depreciable, going forward, whatever is the balance, that will not be allowed to be claimed as on which you can claim a depreciation. So I think that's the two key amendments that were brought in, and I think we will see the ramifications of each of them. The other big change was around the slump sale concept. There was, not in the budget 2021, but in the Finance Act 2021, a change that was introduced, which talked about how the fair value in case of a transfer of a business undertaking would be determined. And that would be deemed to be the full value of consideration in relation to which a capital gains would be computed. Again, this amendment was brought into from assessment year 2021-22, which means that it applies for the financial year ending March 31, 2021. What does the rule say? The rule which came into effect, Wide Notification number 68 of 2021, from 24th of May 2021, states that the fair market value will be the higher of two components. Component one is what I call the adjusted NAV method, which means that every asset that is comprised in the business undertaking will be calculated basis the 11 UA methodology of valuation provided in the income tax rules. So assets like shares, immovable property, jewelry, would be separately calculated. The rest is all book value. That is one methodology. The second methodology is around what I am going to receive when I sell. and that is either actual cash plus if I receive any asset, then again I need to look at the 11 UA value. So if it is a movable property received as a consideration plus stamp duty value of immovable property received, that would be deemed to be the consideration. So if I receive shares of a listed company, then I have to take that as a basis, and the listed price becomes the fair value. If I receive equity shares of an unlisted company, then the NAV becomes the fair value. So, that's the methodology which is being prescribed. There is a dichotomy to my mind, which we will discuss a little later. I'll just park it for the moment, is that this sub-rule 2 or the adjusted NAV method, does it create any implications when we look at slum sale and the way it is defined under the Income Tax Act? So that's something that I'll just want to park for the time being and come back at a later date. And the second point that I want to say is as to when does this fair market value come into play? Does it come into play from April 1, 2020? Does it come into play from April 1, 2021? Or does it come into play from May 24, 2021? That's an interesting proposition. Or does it come into play from April 1, 2022 only? So we need to just look at, from that perspective, and we will discuss that as we move further into the presentation. What were the changes? What was the position prior to the Finance Act? Basically, the Finance Act prior to 2021, and therefore the Income Tax Act, talked of slum sale to mean only the sale for a lump sum consideration of a business undertaking without values being assigned to individual assets and liabilities in such case. So I think the underlying principles were three. It has to be a business undertaking, it has to be a lump sum consideration, and we will not allocate individual values to assets and liabilities. So these were the three main tenets of a slum sale. Then they prescribed under 50B, section 50B, the capital gains on the slum sale. And it says that whatever was the sale consideration received minus the net worth of the undertaking. And the net worth of the undertaking was calculated in a prescribed manner, which would mean aggregate value of total assets, which is, the taxed written down value in case of depreciable assets and book value in case of non-depreciable assets, minus the value of liabilities, ignoring all revaluations that were being done. And that's how the net worth was being. Now, obviously, there was no valuation methodology prescribed for determining sales consideration. Other thing was there was no indexation benefit. And obviously, the capital gains, whether it is long-term or short-term, was dependent on the period of holding of the undertaking. There were certain decisions that came into play at that time as to how this net worth has to be computed. And one of those decisions clearly spelled out that if there was a negative net worth, then the same had to be added to the value of the consideration. So assuming that my consideration was 200, I had a negative net worth of 60. Therefore, the capital gains would be computed on the basis of 200 minus 60, which means 200 plus 60 on the basis of 260. Other thing that was important is that if any capital asset expenditure was claimed as a deduction under section 35AD, then for the net worth, that value was to be taken as nil. So those were the criteria that were there for slum sale prior to the amendment. Then what has happened in terms of certain elements of sale? One of the concepts that got developed, because the slum sale was only looking at sale of an undertaking for lump sum consideration, and sale as per legal parlance would mean where you are receiving cash consideration. So a view emerged that section 50B, which talks of taxing a slum sale transaction, would not apply to a slum exchange, because in a slum exchange, the consideration is not cash, but is other than cash. Now, obviously, whether the transaction is of an exchange or a sale needs to be determined based on the facts of the transaction. The Bombay High Court, in case of Bharat Bijli, after looking at the provisions of the Act, did lay out that the transaction of transfer of the undertaking in that case was taken by other than a sale mode, and therefore it cannot be considered and taxed as slum sale. Later on, the same was followed by the Madras High Court in the case of Areva and TND India, 119 taxman.com 171. Interestingly, there was another argument which was put forth by the tax authorities is, okay, the transaction may not be taxable under section 50B. Why can't we tax it under the general provisions of section 45, which taxes capital gains on transfer of a capital asset? Now, all of us know that a business asset is a capital asset, and therefore any transfer would generally fall under section 45 because it's a general section. The Bombay Tribunal further analyzed this in the case of Avaya Global Connect and came to a conclusion that yes, while it is a capital asset to be taxed, to be considered for taxation under section 45, it is not possible to determine the cost of acquisition of that undertaking, of that capital asset, and therefore the taxability cannot be determined under section 45. It applied the ratio of the Supreme Court in case of BC Srinivasa Sethi, that if the cost cannot be determined, you cannot tax the full consideration. So, basis all of these favorable decisions, a lot of transactions were being done from a slum exchange perspective. Did this position change when GAR was introduced on April 1, 17? Yes, what it meant was that if I have a commercial rationale to do a slum exchange instead of a slum sale, I can clearly look at slum exchange, but I will need a commercial rationale. Now, in my experience, what buyers used to come that I don't have full cash. I have part cash, but I have my own security which I can issue as a liquid instrument. And therefore, there were transactions which were done on that basis where cash was not involved, but, a asset was involved to settle the sale consideration or the business undertaking transfer consideration, if I can call it, because I don't want to use the word sale because that denotes as cash or transfer. So that's how the position got a little more subtle after the introduction of GAR, and commercial rationale became one of the important elements. Similarly, goodwill prior to the Finance Act 2021. So, under section 32(1)(2), intangible assets was introduced around 2001 to be a depreciable asset. Now, it specified certain assets which were very, very clearly spelled out. For example, a know-how, a trademark, a copyright, a patent, a license, or a franchisee. And then it had, a rather general one which says, or any other business or commercial right of a similar nature. Now, what will fit into this, what will not fit into this has always been a subject matter of contention or even, analysis. Now, goodwill obviously was not specifically included in such list, and therefore the question happened whether depreciation on goodwill can be claimed. And while people were, wanting to claim it, I think they were hesitant, and therefore when we went to councils on those matters, what we were advised is, yes, it falls within the business or other commercial right, but please do pay your advance tax as if this is not going to be allowed. So at least, the interest and other aspects do not come and hit us. Then somewhere around 2012, the Supreme Court had an occasion to deal with this. And in the case of Smith Securities Limited, it laid down the proposition that goodwill is subject to a depreciation. So goodwill is a depreciable asset. Moment Supreme Court laid this down in the case of a merger, I think the rationale of the decision was picked up, especially in cases of slum acquisitions, to say that while in case of merger there may be other issues which may come up, and we will talk about it in the next slide. However, in case of a slum acquisition, there should not be any doubt whatsoever because a consideration is being paid. The seller is subject to tax on a slum sale. Therefore, there is no question of not allowing goodwill because the rationale that the Supreme Court laid down in Smith Securities should apply in case of a business acquisition goodwill. However, despite the Supreme Court judgment, litigation continued unabated. Even after the Supreme Court judgment in the Bangalore Tribunal in case of United Breweries, did say that a goodwill that is created pursuant to merger does not become eligible to claim depreciation. And why did they come to that broadly? Was on the basis that there is no enhancement of the written down block that is possible under the 6th proviso to section 32(1) because it is a merger or a demerger, and those are tax neutral events, and therefore there is a mechanism which has been prescribed. Then what was the rationale for the government to introduce the amendments? If I look at maybe the slum sale to begin with, what the government felt was that they needed to expand the definition of business transfers by covering events where the settlement of consideration is through non-monetary mechanism. I think they wanted to go basically on the substance rather than the form of the transaction. And that's how they have made it very clear that those will be subject to tax. Therefore, they have also said that the impossibility to calculate capital gains from such transfer will now be taken away because they have extended the definition of the term slum sale under the Income Tax Act to include any transfer of whatsoever nature. And therefore, any exchange is directly covered as a result of that. Second was obviously the slum sale at fair market value. I think there were a lot of intergroup transactions where the transactions were happening without the commercial reality of the values. So they felt that it is a need to prescribe a mechanism to compute or calculate the consideration and what should be the full value of consideration. And at least here the one good thing is they have done the tried and tested. There is already a mechanism for calculation for section 56(2)(10), which is the deemed gift provisions, and I think they are broadly aligned with that in terms of how the fair market value for business undertakings will be looked at. And I think we will have that covered by Pinkesh in a few minutes from now. So we will have a deep dive on that in that session. The question that one needs to then go is that yes, when you acquire business, goodwill will also be acquired. And therefore, you were willing to pay a price for that goodwill, which would have also given you some tax break. But with the same stroke of pen, the government took away that benefit of depreciation on goodwill by saying that, and which is something which, at least I am not able to reconcile, frankly, saying that the goodwill is not a depreciable asset. It can only see appreciation, and there is no alternative of the depreciation in its values. Now, over the years, we have seen companies go up, go down. For example, if I were to take Nokia, at one point of time, its goodwill was whatever it was. Now, today, do we even remember Nokia? Right? I mean, so there are companies which will, get into those, and then can somebody say if somebody had acquired Nokia in the good times, can somebody say that the goodwill has not depreciated? So I think that's something which is, frankly, not in tune with what even the accounting standards are saying, because the accounting standards does consider a concept where the goodwill has to be tested for whether its value is intact or impaired. Now, if general parlance, if accounting standards do prescribe for all this, can tax, just say that it is not a depreciable asset? So I think this has come as a big shock for a lot of people on the goodwill side, especially on business acquisitions, and it has rewritten some of the value parameters in a deal when acquirers are looking at deals. What's the global practice, right? So if I look at countries like US, UK, Germany, Canada, Italy, they do allow amortization, as they call it, or depreciation as we call it, on goodwill. But there are countries like China and France which do not allow goodwill amortization or depreciation. So there is a mixed bag in the global world on this front. In fact, US has a very interesting model where it allows depreciation or amortization on goodwill over a much longer period called 15 years. I think that's something that one can look at. Now, having stated that, is there no hope for us when we look at goodwill, or is there a way to look at the goodwill in a slightly amended form? And we can consider some of that as we move along and talk about it in terms of the issues that will come up. So can I say now, earlier I was doing a general classification as goodwill. Now, can I look at a classification which is much more nuanced to say that no, I am having customer contacts, marketing know-how, marketing sales channels, and the likes, and therefore it will fall in other commercial or business rights of a similar nature, and therefore accordingly claim goodwill on those, claim depreciation on those elements, and leave goodwill, which will still be a number, which will be the balancing figure, and not claim on that. We will see much more nuanced valuations now come into play, and maybe Pinkesh can throw some more light on that when he has his session going forward. So now we want to just raise a very quick poll question with you, that do retrospective amendments in the union budget involving slum sale and goodwill hurt investor sentiments towards India? And maybe Naveen, you can start the polling now, and the question is yes or no. So if we can, if you all can please poll, it would be very nice. We can understand where you are coming from. And what I see on the poll, I think 95% of us, okay, it's dropped down to 92% of us believe that yes, it will impact investor sentiments, and around 5% were in the maybe category. Okay, so thank you for your polls. Maybe I'll end the poll. Basically, we have roughly around 87% telling us that yes, it will impact. 6% feel that it won't impact, and the balance are saying it may be. Thank you for your poll on this one. I will move on to probably the next one. So what is the impact of these amendments, as we said, of slum exchange, right? First, foremost, as we said, it is applicable from 1st April 2020 onwards, because it is applying for assessment year 21-22. So all transactions which are pending before the NCLT for approval, where the appointed date is prior to March 31, 2021, but after April 1, 2020, are there ways to look for to deal with this taxation? From an acquirer's perspective, do I look at trying to change it to look for deferred consideration, or do I change some other deal counters? Because suddenly now my internal rate of return, as any acquirer would have it, is getting impacted, because I'm not going to be able to claim depreciation on goodwill as a part of the slum exchange that I'm going to acquire. Similarly, for the sellers, they might be taxable fully just now. Do they want to defer their consideration so that if there is any loss events that may occur later, they can offset some of this capital gains with that loss or the business loss in that year? So I think maybe there are ways to relook at it depending on your business situation and see whether something can be done. Now, what happens to transactions which are already executed during FY21? because what has happened is that your results were announced maybe before May 24, 2021 in case of listed entities, but there was no mechanism to figure out, what was the fair market value, because the fair market value concept and the rules were not notified till then day. So do I need to go back and recalibrate my accounts where board has already approved it prior to the notification, or do I take it in the current quarter and give the impact of a prior period item? Now that becomes an important element to deal with, because of a change in the law. And I think what I understand, broadly on this point is that people will change it for the current in the current quarter. So you might see some impact in some companies come as a result of this FMV, wherever it is higher than, what has already been provided in the FY21 accounts in terms of the taxability. The cost of acquisition in the hands of a buyer and upon subsequent sale of the company, will it be linked to fair market value or not? So when I acquire a business and let's say the seller is being taxed on the basis of a fair market value, which is under sub rule for the assets being given, whereas my consideration that I would have paid would be lower, actual consideration. But because of that deeming, going forward, does the deeming of the seller become the cost of the buyer? And I think that's going to be a big question, because while on one hand you are taxing the seller at a higher value, probably you are not giving the buyer the benefit of that higher value, and therefore he may still be able to claim whatever the undertaking value based either for depreciable assets or for other assets as well as goodwill based on what he has actually paid. So that's going to be another important element. And then always there remains this practical difficulty of valuing unquoted shares wherever there is a cross holding. How do I value? Because then it becomes a sort of a no ending game, and maybe Pinkesh can throw some light on that when we talk on this. So are there any tax plannings that is possible post this? So I think one of the aspects which we briefly touched was around basically, the concept of how does one see the breakup of the goodwill in different assets other than the normal intangible assets, and is there a way to look at for that and claim a depreciation on that? The other element that will come into play is that does this apply to transactions which were closed prior to May 24, 2021? Because there is a universal principle of law that the law applies as on April 1 of a given year in respect of taxability of a previous year. Now for transactions which were done in March 2021, as of 1st April, there is no notification which says how the fair market value has to be determined. So, as the Supreme Court has laid out in several decisions, starting from Istimian Steamship, 20 ITR 572, Karima Tharui Tea Estate, 60 ITR 262, Reliance Jute and Industries, 120 ITR 921, Shah Sadiq and Sons, 166 ITR 102, and a recent one, Sri Chaudhary Transport Company, 426 ITR 284. That whatever is applicable on 1st April of an assessment year is a law applicable for the previous year. And these are either 2-judge bench, 3-judge bench, or even a constitution bench, as in the case of Karima Tharui. So it's a settled principle. Further, Section 295(4) says that CBDT has a power to give retrospective effect. However, no such retrospective effect can prejudicially affect an interest of an assessee. Now, if as a result of this notification, my taxability is going to go up, can I take umbrage to say it should apply only prospectively because of what the Supreme Court has laid down in those several decisions, as well as the provisions of Section 295(4). So that is going to be an important element on the slum sale fair value concept that will come into play as we move forward, and we need to just bear that in mind on an overall basis. Goodwill, again, it is retrospective. there is going to be an impact on companies, as they look at completing or near completion deals. For deals which are undertaking in FY21, depreciation claimed till March 31, 2020 will be reduced from the purchase cost of the book value of goodwill, and the balance will be allowed to be carried forward as goodwill of the business. Similarly, for schemes of amalgamation with appointed date prior to March 31, 2020, tax authorities could draw analogy from the amendment to disallow depreciation on goodwill. However, to my mind, that may be difficult now, because if they wanted to do a retrospective even right from the start, they would have done that. But since it is from March, for the financial year ending March 31, 2021, I think for the financial years ending March 31, 2020 or earlier, Smith Securities may become a even more valid law. But you will see the litigation continue on this, despite of the Supreme Court decisions. And I think we've spoken about the realignment of the goodwill among the different elements. Then your second poll question, which is important, is and which is what we wanted to understand your view on. How does the value of goodwill of business tend to move over time? The first is value of goodwill of a business only appreciates over time. Value of goodwill only depreciates over time. Value may fluctuate depending on customer sentiments. So I'll just wait for a few seconds, as people are polling in. So I think I will then end the poll, because what I see is there is an unanimous consent on the value may fluctuate depending upon customer sentiments. And therefore, I think there is a strong need to go back to the government and make a representation on this element. Quickly move on to slum sale at fair market value. We have discussed this, but there are a couple of concepts which I wanted to just raise. The very definition of slum sale talks about, no individual assets being assigned values. Whereas the rules 11 UAE and sub rule 2 in particular talks of assigning individual values to the assets. So, the section and the sub rule are incongruous. Now, can an officer tomorrow say that you yourself have assigned values under the sub rule, and therefore this is not a slum sale but an itemized asset sale, and I would like to look at it in that way. Now, we need, while these are rules which are framed by the CBDT, and we are just looking at it to determine the capital gains computation and for no other purposes. And therefore, to that extent, can somebody say that the slum sale is not for a lump sum consideration, but it is for assigned values? I think that would be far-fetched to my mind, but one cannot rule out an officer raising these issues, and then you will need to enter into litigation to settle that. I think again there is a need to make representations through all the chambers to enable this to be ironed out, and say, like for purposes of stamp duty there on immovable property, they have clarified that if you specify a value in the conveyance documents for immovable property, that will not be considered to be a value assigned to an individual asset. I think we need a similar clarification so that this issue is not picked up. The next issue is around what happens in a SAR applicability versus GAR applicability. So, for example, that if we were to have a slum sale which is let's say giving us a value as per the fair market value of 150, and I actually transfer it at 150 basis that valuation. Subsequently, I have transferred the business to one of my subsidiaries, and I have now got further fundraise in that subsidiary. But the fundraise has been made not at 150 valuation of the subsidiary, but at 250 valuation of the subsidiary. Can somebody say that you should have transferred the business at 250 because that was the fair value? What you have done is transferred it at 150, which is the tax fair value. And therefore, the debate about GAR applicability in a SAR situation, comes into play. And this will therefore be better in such situations that we have enough commercial rationale as to why we have transferred it at the tax fair market value, so that even if the officer wants to apply GAR, there are enough justifications that one can play out with. Frankly, even if they had done this to an outside party, they could have only taxed me on a tax FMB basis. So that to my mind should be the overall basis, but better to have commercial rationale so that it's easier. The next question that we have is, would the value of undertaking determined as per 11 UA be looked upon as a go-to price in inter-group reorganization? So when you want to do inter-group reorganizations, will you do the valuation basis, the 11 UA E value, and then close your transactions accordingly? We can look at that as a next poll. Naveen, if you can just, yeah. So if you can quickly give your answers to that. No, I think Naveen, we'll move to the other one. Okay, while the polling is happening, the key questions that are going to come up for future is that when I have acquired a business and now I'm selling a part of that business, how do I attribute the goodwill that was determined in the first acquisition, which was of a composite business, when I'm selling a part of the business? So should I, when I'm acquiring business, attribute the goodwill into different elements of that business right from day one? Or should I wait when I'm likely to sell? Because when I acquire a business, there is no question of me thinking about selling it in an immediate near future. But there are certain situations where such acquisitions are made and businesses are sold within a short time frame. So how does one look at it? Because there is no mechanism provided for bifurcation. So that's, I think, going to be an interesting element, an interesting sphere to look at. We've discussed about goodwill, whether it is tested for impairment and should be amortizable, and I mean you've given your answers to this. For open assessments, is there a risk that the tax department may now disallow depreciation on goodwill going forward? I think this is going to be an interesting sphere. To my mind, at least with the amendments and the way they have come up, I think we have been able to, come out of it in that sense, because there is much better footing for Smith Securities. So to that extent, I think while litigation may ensue, but the chances of win in the higher forums is much better now with these changes. And they have not stated that they, in a way, clarificatory in that sense. So from that perspective, I think it will be much better. I think we've looked at the last questions, in that sense, whether the recent amendments respect to goodwill. So, Naveen, if you can put that question. Yeah, I think he's put it. Whether recent amendments respect to goodwill, slum sale, and deemed consideration for slum sale result in a dip in the slum sale transfers. Yeah. So if you all can quickly provide this, and I'll hand over the mic to for Pinkesh. We will answer questions at the end. Maybe Naveen, we can switch to Pinkesh's presentation while we get the answers on the polling. So what we are seeing here is, just to give a very brief on the poll while the presentation for Pinkesh is coming up, is that 57% of us feel that yes, it will result in a slowdown or a dip in some sale transactions. 25% are saying it may be, and roughly 16% are saying no. I would think that some of these transactions will now get done in the mode of mergers stroke demergers, which will be more tax neutral, rather than paying tax, especially in intergroup transactions. So with that, I will hand over the baton to Pinkesh. Pinkesh, over to you. Thank you. Naveen? Yeah, I mean, you can put Pinkesh's presentation. Yeah, thank you. Pinkesh, over to you. Hello, Pinkesh.
Amrish, I think Pinkesh has just dropped. He's facing some issues. So he'll join in a couple of minutes. So in the meantime, till he joins, Amrish, would you like to take a few questions from the chat box?
Yeah, sure, we can take those.
So you can start from the bottom. So there are few queries. So in fact, the one common query which I have noticed that since goodwill represent the intangible assets which commands the premium of any slum sale. So it can be a trade license, trade name, trademark, copyright, and the intrinsic value of these assets are sometimes higher than the book value. And in fact, these items are not even captured in the books as they are self-generated. So most of the participants they have very common query. So whether we can break down the goodwill into these intangible assets and the claim depreciation on those assets because these are the covered assets within the meaning of intangible asset. So how far do you see its acceptability and do you see any scope of litigation on this aspect?
Right. So clearly, if it is self-generated, then even earlier depreciation on those was not available for any self-generated asset. I think that's very clear. Only when you are not self-generated asset or when you have acquired an asset. So let's say today when you look at any business acquisition, I think earlier because of Swiss, many of us were just putting goodwill as one intangible asset without breaking it into patents, trademarks, know-how, technology know-how. I think going forward, better to just split it into as many assets because what I have seen in several valuation reports is goodwill comprises of the following elements. So they would mention it in the report, but there would be a singular number for goodwill. I think going forward, we will have to break this into several elements so as to be able to fall within those defined terms that are there for depreciation claim from on those assets and not call it goodwill. Goodwill can be still be the residual overall thing which is outside of this intangible assets. Yeah, so maybe Pinkesh is here. We can then.
So Amrish, Pinkesh.
Hi.
Yeah, hi Pinkesh. So over to
Am
you.
I audible?
Yes, you're audible. So Amrish has done with his presentation. Now you can take over. So over to you, Pinkesh.
Thank you. Thank you. In fact, I was thrown out of the session. So it was like the valuer's feeling which the computation that the tax office has now given. So valuer's role has got limited, I guess. So purposefully, Naveen and team, you would have thrown me out. But no, coming back on the topic, valuation per se remains an integral part of any deal. And for that matter, an important piece of assessment for the tax department as well to evaluate how much tax they need to charge on any transaction. So like valuation is in vogue, even the tax department has caught in and has decided to create its own way of computation for valuation to determine the minimum taxable fair market value for a slum sale. Speak about valuation methodologies for the slum sale given the new regulations and on how do we treat and how do we mitigate the loss on account of disallowance of good depreciation on goodwill. So with that I'll move forward. What the tax department has done, government has also is an extent. Hello.
Pinkesh, can I request you? You can switch off your camera, so you'll have better clarity in your voice.
Sure.
I think there's some network issues.
Sure, no problem.
You can switch off your camera.
I did. Thank you. So the important rule 11 UAE, which has been introduced for valuation methodologies for slum sale, is actually an extension of, if you recall, rule 11 UA, which is applicable shares. So per se, the government and the tax department has come out is with a clarity and confirmation that the way to compute tax determinable fair market value should remain the same irrespective whether you're doing a transfer of shares or an underlying business. So that to that extent, it is a good thing. It comes with the clarity and uh, confirmation that the methodology is the same. In fact, I should say, in fact, this approach is likely or almost similar to the itemized asset sale, because in those case also, if you recollect, some of the type of assets, specific assets like immovable property, etc., we would have still gone and done the deal on a stamp duty rate or the circle rate. So all those have got introduced into the Rule 11 UA, and now for the slum sale, it is Rule 11 UAE. I know Amrish explained in detail everything, but from a valuation standpoint, I will elaborate. The intention of this again is to determine minimum taxable fair market value of the business which is being transferred for slum sale. The intention is not to dictate the deal value, actual deal value, whether it is internal transaction or for external. It is an intention only to determine the minimum taxable FMV. Now, the way they have started, and it's a computation, it's not left to a valuer or a professional or a registered valuer to do a full computation. But what it says, it gives a step by step guide on how to start the valuation, what should be the date of valuation, which should in case if part of the division which or the undertaking or the business that is being sold or transferred under slum sale, you can say there are few key assets which are generally you can see in a business. One is immovable property, which they have specifically said you have to ignore the book value or the tax book value and consider the current stamp duty value or the circle rate as prevalent. Second, if it has shares, for that they've given a separate uh, understanding. In case if the shares are quoted or securities are quoted, then you have to consider the market price as on the transaction date, and if there is no transaction on the previous date. In case if the shares are there which are unquoted, then you have to reperform the Rule 11 UA on those companies. So what brings an important topic, which I think Amrish also referred, is it becomes a circuitous route. If it's a investment into a shares which has further shares as a subsidiary or an investment, they've not differentiated between a subsidiary or a associate or any kind of investment. You are expected to perform Rule 11 UA, or will come across as to whether it is practical, whether you will have all latest information for all the companies, and whether that information can be prepared for a transaction date which will never coincide with a financial year end or a quarter year end when the accounts are made. So to that extent, those practical challenges come in play. For unquoted securities, which are, and when I am stressing on the word securities other than equity shares, and for some other specified assets like jewelry, artistic work, one has to look at what those assets can fetch in the open market. To that extent, in some case, they have mentioned that you have to obtain a valuation report from a registered valuer. So to arrive at one tax computation, there could be a chance of getting into a stamp duty valuation for an immovable property, security other than shares which is not listed, and you have to see or check what would be the fair market value or realizable value in the open market. Same thing for jewelry, same thing for artistic work. So that is one element of it, is in terms of adjusted book value adjustments for quoted shares and securities, unquoted equity shares, jewelry, artistic work, securities other than equity, and immovable property. So those all put together will give you one set of value. The tax authority has said, from in case of a slump exchange, you also need to figure out what is the monetary consideration or the non-monetary consideration. Higher of the two needs to be considered. So either the amount that we are charging the other party, or in a slump exchange, what is the fair value of the tax FMV that we are receiving. The higher of the two will have to be considered. So that is how one has to look at the taxability or the tax FMV computation. As far as monetary consideration is concerned, the usual methods of valuation one could have deployed, like to arrive at a deal value, you could have done under the discounted free cash flow, combination of market approach, asset approach, or even it could have been negotiated between two parties without any valuation technique being put into place. However, what we understand is that will not be in question, because the comparison is the adjusted book value versus the monetary consideration. In case of there is only monetary consideration. If there is a non-monetary consideration, we have to again repeat the rule 11 UA, look for adjusted values for properties, immovable properties, shares, jewelry, start with the balance sheet and figure out what is the higher of the two. So moving forward, in case of a moving forward, what are we talking about? We are talking about book value method adjusted for certain elements, as was given in rule 11 UA, needs to be repeated in slum sale also. Now, financial books, not tax books, as on the transaction date, the question is not yet very clear whether it should be audited accounts as on the transaction date, but if you refer to the rule 11, there is a reference to audited accounts. Because since this is a carve out, slum sale, you will have a carve out accounts, but then you have an ability to perform some kind of audit and reviews. Again, what is being proposed is a prescribed manner of computation rather than a fair market valuation approach. So it is bound to be little practical, negligible size compared to the balance sheet, but you're still expected to carry out the stamp duty value. Same thing, many of the companies and divisions would have shares of cooperative share, or for that matter, investments which are small, and you may not get updated values or updated information, financial information. How do you look at it? So there is some challenge on the practicality part of it, but we will have to work with it. I think materiality wise, it will have to follow, because the slum sale, the business would be critical. With some caveats, one will have to use it, but we have to test it how the tax department looks at it going forward. There is always a challenge of getting updated information for various companies, where even if it's a large investment, but the transaction date is as on odd date. As I mentioned earlier, it need not be all transactions happen on the quarter end or the financial year end to get a certainty on it. One more common example that can come up as an issue is in any slum sale, you would find immovable property. Now the stamp duty value is a standard value that has been regarded. However, not all of the property dealings or the holdings are clean. What about if there is a dispute on the property, if there is a possession issue, or if there is an issue with a locational disadvantage, alternative use not available, or locked into something, but there is no leeway given. As I mentioned, it's a prescribed computation, so one will have to live with it. I would also like to bring on table, how about in special cases? When I say special cases, means it could be a distressed sale. So the value at which the transaction could have entered could be lower than the book value. But from a tax computation and a taxability FMV perspective, it will have to follow the the Rule 11 UAE or Rule 11 UA for the shares and proceed with the tax liability. Similarly, in cases where it is under IBC or companies which have a large balance sheet but are not yielding good results going forward, and valuations and deals happen on go forward cash flows and the returns expected, and if the returns are below par, below market, then the fair value could be going below the market price. That could be a situation. So these are the issues which can come up for computation, but as I mentioned, we are talking about a computation. So to that extent, we will have to live with this issues around it. We can also evaluate now, as I mentioned, these are the practical issues with Rule 11 UA UAE and how one will have to look at it. Now, let us evaluate how it impacts some of the transactions or deals. So impact on an internal group restructuring. The answer could be both, a good and a bad. Somebody would be happy saying that it brings a certainty to the taxability part of it. For some who would have done a deal below or wanted to do a deal below the book value or below the tax book value, would now have to, even if they do the deal, they will have to pay taxes, compute the taxes based on the tax FMV as laid down in Rule 11 UAE. So it has mixed impact on internal transactions, how to do it. Certainly there are possibilities of restructuring, as we heard from Amrish, but this is what. And on impact on third party transaction. Generally, I would say that in a third party transaction, it would be more on an arm's length basis, more on a commercial basis, and you would go and extract the maximum value that you can get from the other party, from the buyer. So to that extent, a third party transaction deal value may not get affected because of the Rule 11 UAE. However, because of the points mentioned above, there is a possibility for restructuring. There is a possibility of structuring a deal in a more efficient manner, as Amrish has also laid out. So that is where, as far as third party transaction deals are concerned. Now, this also brings us, while slump sale as a definition talks about lump sum consideration without breaking it or apportioning to individual assets, but the way the Rule 11 UAE is detailing, we are talking about, is it pseudo itemized sale? I'm just throwing this pointers. I know Amrish and team has covered it, but I think these are the questions one can look at it. Does it go against the slump sale definition? That is one. Second, there are many transactions which happen where corporate governance, transfer pricing, FEMA all call for arm's length pricing, ALP, versus this tax FMV. So in a particular deal, you can expect a lot of complexities, different kind of valuers getting involved, different kinds of definitions to meet different regulations and authorities, right from RBI to transfer pricing to tax authority, stamp office, etc. So with all of this, we are into a play. Valuation still continues to be part of the integral team of any deal, and Rule 11 UAE has also added one more complexity. Having said this, I would say, in case it makes it mandatory for any large deal or any deal to have a valuation report under Rule 11 UAE, one should attempt to start the work on the tax FMV computation much earlier in advance when you start negotiating a deal. And the reason being, as I mentioned, there are multiple information is required. The starting point is easy in terms of the financial books, but what is critical is all other types of information that is required. Valuation report for immovable property. If there is jewelry, you need a registered valuer. For any other asset, you need to know whether it's quoted, unquoted shares, or of any subsidiaries, you need to rerun the Rule 11 UA. So there is a lot of efforts going to go into this. We can start the work early so that during your negotiation, we are well aware what is the level of tax FMV that is getting worked out. and obviously as per the rule requirements, post the transaction date, when the balance sheet is finalized, one can firm up the net asset position, which is going to be slum sale, and do a valuation and issue a report later on. So that is the approach I would suggest to go forward. Now, from the slum sale, I think I will move to the next topic, which is also important from what a deal structuring and actually deal making is concerned. And so I also saw some questions on goodwill, whether it is recognized or defined in the law or other things. Generally, goodwill is as generally understood. In the earlier days, people did not used to make a differentiation between the intangibles. Value less the tangible assets in the books was ascribed as goodwill. You can say it was all residual intangibles. All intangibles or residual intangibles was all clubbed under goodwill. Now, with this new regulation, which takes away depreciation on goodwill, it makes a deal little more costlier. It takes it to renegotiate as to, because it makes it costlier, you're not going to get a tax amortization or tax depreciation benefit on it. So of course, so suddenly goodwill, which used to be the benchmark of carrying out valuation, like super profits, 5 times of super profit or a goodwill, has suddenly become an ugly word. Not from that perspective, but from a tax amortization perspective, it is not a word that people want to ascribe to. Any value over and above the tangible assets value, how do you want to ascribe? So that brings us to an attention to which are the other intangibles which we can get in a business. I'm listing down a host of intangibles and categories of intangibles on the slide. It could be customer related, like the customer list, customer contracts, customer relationships, non-contractual customer relationships, technology based, patented technology, computer software, databases, trade secrets, etc. Some of them could be like contract based, licensing, royalty, supply contract, lease contract, favorable, unfavorable lease contract, franchisee contracts. Lot of them can be housed under marketing as well. Trademarks, trade names, competition agreements, internet domain names, etc. And the ones which you usually don't see it in the business are the artistic ones, like the plays, operas, ballets, and etc. So while I am listing down these categories and the detailing of the intangibles, in any slum sale or in any particular slum sale that you are evaluating, you will not find all of them applicable. So it brings us to the table that it is very important from a fact base and from a deal perspective on hand, whether out of these 5 heads and subcategories, which one are more eligible, which one are more recognizable to our deal and the business, and which can be justified from a tax perspective to say that it is actually an intangible which can be valued and recorded and considered in the depreciable block of the tax books. So this is an important point. SSC will have to ensure out of the large list of intangibles which one are applicable to them, and proceed with a valuation report which is robust, detailed, and captures the valuation approach, reasoning, methodologies for some of them which we pick up from these lists. This is how one will have to progress in order to mitigate some part of the loss because of the goodwill. Because as Amrish mentioned earlier, it was earlier people would have just aggregated everything or did not, or evaluated only top 2 or 3 of the intangibles, and balance was settled as residual goodwill. But now the efforts will have to go more deeper. So coming to which type of methodology should we consider and how should we consider it from a valuation standpoint? So valuation methods for intangible assets: income approach, market approach, cost approach. Very similar to the business valuation that we generally consider. and we spoke about during the monetary consideration slide earlier. So under the income approach also, we have multiple methods like the multi-period excess earnings, which could be easily applied for customer relationship. Relief from royalty, again for brands, trademarks, patents. Incremental cash flow method for non-compete, favorable, unfavorable contracts. Market approach, it could be based on comparable transaction approach. If a trademark in the pharma business was sold at a particular X time the revenue, or it could be or X time the multiple of the profits, we can use those examples. Cost approach, replacement cost approach, which could be for workforce, early stage technology, or early stage anything new that we were trying to figure out, but it is too early to really peg a market value. We can still go with a cost approach. So again, these are the approaches on a larger basis, depending on the type of the deal, type of the underlying business, and the intangible which can be attributed. We will have to, the valuers will have to take into account under this which is the right approach, whether it is the multi-period excess earning or the relief from royalty or the replacement cost approach, and detail it in the report. What makes it more important today with is we are going to be against the tax department, who would also want to maximize their revenues, that one should have a detailed report, a robust analysis, and justify from a business sense why out of the 10-20 intangibles that we listed earlier, top 5 are these, 7 of them are these, and these are must, and the value attributable is maximum to these ones. Again, as I mentioned, with the taking away of the depreciation on the goodwill benefit, renegotiations, it becomes a costly affair for the buyer. Negotiations, they may have to relook at it. It makes it critical to carry out pre and post purchase price allocation and intangibles valuation at the time of the deal and at the conclusion, so that we are well aware. It helps you in negotiation very well. And ultimately, from a tax department and a scrutiny perspective at the end, documentation, proper logics, rationale of a report will help you in a big way in meeting your objective of it. So I think with this, I was trying to cover the valuation methodologies for the slum sale and for the intangibles which one can deploy, considering the new changes in the law. Back to you, Amrish and Naveen.
Thank you, Pinkesh. It was really insightful. In fact, I had a lot of queries on slum sale and depreciation, on which I have got the clarity. But yes, there are a few more questions which our participants have entered in the chat box. So may I request Amrish and Pinkesh to take these questions, so you can start from the bottom. So I would say you can club them together and there won't be more than 10 queries to address.
Yeah, so I think, Naveen, I think some of the questions, as you rightly put, are very similar. I mean, in their broad construct. Obviously, each question is unique in its own way. So one of the questions is around, and I've started answering some of the questions on the chat box while Pinkesh was talking, so maybe I'll not repeat those because it's maybe gone to everybody. So one of the questions was around basically how the other intangible assets needs to be looked at going forward, and how will one try and bifurcate the same on an overall perspective. I think Pinkesh has just broadly covered that, what are those elements, those 5 or 6 streams that one can think of, and how one has to look at detailed valuation for the same. And I think that will itself, give us some of the answers in terms of where we can bifurcate in a given fact pattern and where we cannot bifurcate. So I think that will be something which will be important. The other question which I have seen is, whether around is the rule overriding the section, and I don't think so, because the section itself provides for the rule. So it prescribes that something will be prescribed. So I don't think the rule can override the section. I've already covered how the rule and the slum sale definition itself are incongruous, and therefore there's a need to get some clarification, like the similar one that is there for stamp duty for import property. because then it will lay out any other issues that may come up on this front. Well, there's another question which is saying that if there's an asset which is not appearing in the balance sheet of the undertaking for intangible assets, then does it have to be valued? And the answer is for the buyer, they will definitely want to value it. For the seller, if it is self-generated and there is no value appearing, then it doesn't become part of your cost of acquisition of that undertaking, because there is no such thing that is coming there. So to that extent, it won't be considered, but there is no specific methodology under the fair market value determination for intangible assets. The prescribed assets are, whatever is given, basically shares, immovable property, jewelry, and the like. One question which has come 2-3 times is, can we charge goodwill to P&L and claim it as an expense, in the first year? The problem there is that, when you acquire goodwill, you are acquiring a capital asset. Even if you were to write that goodwill off in your balance sheet or in your P&L, under which head of the Income Tax Act will we claim it as a deduction? So that's going to be the key question, because it's not neither a business expense, nor is it something that is deductible under Section 48. And 50B anyway, unless you sell the business itself, you cannot claim it. So there is no other section which I see where you can claim it as a tax expense. You may still be able to write it off to the P&L depending on your situation and whether you are following Ind AS or the old IGAP. But I don't think that there will be a basis for you to claim it in the listing. Pinkesh, there is a question on how cross holdings have to be valued. So if you want to quickly.
Yeah, so that from a practical standpoint, one will have to think, because Rule 11 UA will have to be applied, so it will be a circuitous route to that extent. So somewhere looking at the amount, because we have not seen finally where it stops. We are not looking at a macro to come out with a final result, but the principle has to be followed of Rule 11 UA of valuing the cross holdings.
Yeah. There's another question around if the transfer had happened in prior to March 21 and the rules have come around May 21. I've covered it as part of the discussion that there might be a possibility to take a view that the valuation rules do not apply to it, but it's going to be litigation involved. So yes, while it is possible from a technical perspective, the tax office is going to come hard, because the rule today at least does not prescribe the start date, so it has to be May 24 for that. So one of the questions is that if an NCLT scheme is on and the slum exchange is appointed date falling in the financial year 21 but getting concluded or consummated because of the court order in August 21, can the position taken that the slum exchange is not a taxable event? The definition of slum sale has been changed for the financial year 2021. So to that extent, it will be not possible to take that claim. Even if the court matter or the NCLT matter concludes in August 21. If the date was prior to March 31, 2020, then potentially one could have taken that position. But since it is falling within the year financial year 21, and this is an amendment which applies in that year, may not be possible to take that stand. What is the meaning of immovable property for purposes of relevant UAE? Whether right to use of land will be considered as immovable? I think there is some decision which has recently come that a right to use land is not an immovable property. It has to be the land and the building itself for that purpose. So to my mind, that would be excluded. Pinkesh, there's another question around acquired workforce from a valuation standpoint. Is it to continue as per the same rationale, i.e. future revenue saving in cost? How do we look at it, applying a value to that?
I think where there is an acquired workforce and you paid a price, consideration is already there for it to be evaluated and considered in the books. And from a methodology perspective, you have to typically go through the workforce methodology, which is the replacement cost method, and evaluate it.
Right. Whether Ind AS fair value of assets will be treated as book value for the purpose of computation of net worth. So I think if those assets were revalued, I think the revaluation is to be ignored for the purpose of net worth as been laid out. So to that extent, that won't come into play. There is another question. If the seller has self-generated intangibles for which we determine fair value while doing the slump sale, will it be allowed for tax deduction to the buyer? No, the answer is no. The self-generated intangibles will not be considered at their fair value while doing the slump sale. Okay, I think there is one more question about if any of the so Pinkesh, the question is around if jewelry is a stock in trade, do we need to do fair value when you are looking at 11 UA? So for any stock in trade item, do we need to?
Right. So it is very similar to a real estate entity having immovable property as an inventory. But there is no differentiation mentioned in the Rule 11 UA to take a different position for them. So if a plain reading of it and an application of the computation, like even an operating asset, if it's a land and building which is operating in the business, it has been mentioned that we have to test it for its stamp duty value. So on a similar basis, I would think we have to follow the regulation in the same manner.
I think broadly, these are the questions, Naveen, that, there are lots of other questions also. Maybe we can take them offline and answer to those respective people. I think we are way over the time. Naveen?
Yeah, thanks, Amrish. And so it was really a good webinar. So if there are few queries which could not be answered due to the time, so I'll request the participant, they can drop us an email and we'll try to connect you with the authors directly. So on behalf of Taxman and the participants, so first of all, my sincere thanks to Amrish and Pinkesh for making today's event a grand success. And it was really great that our participants, our users have got the clarity on the subject from the two matter experts. So that's all from my side. And with this, so we'll see you again. So if you have any more issues, just drop us an email at sales@taxman.com and we'll connect you with the authors. Thanks, Pinkesh. Thanks, Amrish.
Thank you.
So much, Shamivel.
Thank you, everyone. Thank you.